this just makes me sad. There are investors out there who got swayed by this bonus depreciation thing, right?
Yes.
They're going to have, they took all this bonus depreciation in year one, and they're going to lose all their equity, and they're still going to owe the recapture tax. Right.
Yeah.
So they're not only are they out their equity, but they're going to be on the hook for a big tax bill.
If you watch the daily financial news this morning, you know that identified that there's $2.8 trillion in commercial loans outstanding. You also heard that 2.2 trillion, or roughly 80% of that, is due to be refied or recast before 2027. You, of course, heard Janet Yellen say silly things like this won't fester and grow. She said the bank system's strong. We've all heard this stuff before. Well, let's get into the news. We've got New York Bancorp, who reported a couple of commercial loans taking significant write-offs. You've obviously seen what happened with that stock. I thought we should talk to somebody in the business, somebody who's been in the business for a long time, somebody who was not buying during the craziness because he couldn't make deals work. I think we are really starting to see the pain come through, Jonathan. I'm hearing more and more directly from people in my network about people losing apartment buildings, about LPs losing real cold hard cash. So I think we should talk about it. I think commercial banking system, right? Smaller banks, which hold roughly 80% of the 2.7 or 2.8 trillion. I don't know how there's not significant pain coming down the pipeline, because that's a massive number, and it's much of it's got to be dealt with in the next 2-3 years. So what says Jonathan?
Yeah. Well, so listen, I read something very scary on this score, which is that, for big banks, something like 27% of their balance sheets are represented by real estate. But for small banks, it's like 40%.
Yeah.
Which if you think about it, makes sense. Like, what else are they going to loan on, these small local and regional banks? Like, they're lending against real estate, which they view as being very stable and very safe, right?
Yep.
And of course, they couldn't help but get caught up in the thing everyone else is caught up in, like, hey, prices are going up, we're going to get paid back. I don't know to what how much exposure they had to floating rate debt as opposed to fixed rate debt. At least the local bankers that I've been talking to tend to just talk about fixed rate debt. I haven't heard them talk about. So perhaps they're slightly sheltered from this issue, as long as and they also tend to go in at lower LTVs than the bigger banks.
Yeah, that's true.
So there may be a little bit of cushion there. Nevertheless, the fact that they're 40% exposed is certainly something to worry about. And I think the banks with some exposure to a lot of office, those are I think the banks that are really, the banks that have a lot of exposure to office, have a lot of exposure to Sunbelt multifamily with with floating rate debt. Those are the banks that.
Well, let's play with this, because I think it's all bad. I mean, I don't mean to be flippant, but I mean, you know this, but for the audience, right? Let's say they are conservative. What would be conservative? 70% LTV, 65%? What would you think is conservative?
Yeah, I mean, I think that 60 to 65%, I would say, is conservative.
So let's call 65.
Yeah, 75 is sort of moderately conservative. 75, so 70 is like moderately conservative. Once you're getting up to 80, I think that's pretty aggressive, but you don't really see that very much. Yeah.
So let's talk about it. Let's just assume for a minute, the average blended rate of 2.8 trillion is 65% LTV. We're just going to make this up for a moment. And let's assume it's all 5 years, right? There's no floating rate. There's none of this. It's just, it'll come due when the 5 years rolls over. You know this. We've seen cap rates go from 4 to 6. And simply said, that's a 50% jump, right? From 4 to 6. Even if you've had NOI growth, it's hard to grow into that. So it's not unheard of for a building to be worth, just in simple math, 35% less.
Yeah.
So if you have $2 trillion, and what would that be? That'd be 35%. So that'd be $700 billion in equity at the time of loan origination. That is suddenly wiped out at the term date. There's a couple of things in that. Equity loses, equity gone. The banks actually aren't in that bad a shape.
Right.
Their debt is, roughly speaking, the value of the asset at that point. Now they're not in the business of owning and blah, blah, blah. But, banks might be okay in that scenario. They're going to take, 4, 5, 7% haircuts on this, that, the other, but it's not the equity, which goes to zero. Does
Yeah.
that math play up?
Well, yeah, I think so. I think it does. I mean, because what I've been reading recently is that this sounds, I mean, this is terrible from the equity perspective, but from the banking perspective, well, this is why they lend the way they do.
Mhm.
The right now, the value of those assets is about equivalent to the value of the debt on those assets,
Exactly.
right?
Exactly.
So which now the issue is, can they get refinanced? No, right? Because they're
No,
not,
but they
because if
can get sold
they
and
can
then
get
take.
sold, yes, they can get sold for that value, and the banks can be made whole. So if that's what you're looking at, then you say, well, okay, no overall banking crisis,
Yeah.
but certainly
Yeah.
a lot of banks in pain, and maybe some
Yeah.
banks that are overly concentrated have a real issue, right?
Yeah.
So, but if you just look at the asset class as a whole, then yeah, the banks are going to be okay, but
Equity
the
gone.
equity is going to be wiped out. Now, another thing I've read, though, I think it was Jay Parsons who might have said and I could be wrong about this, so don't yell at me if this is wrong. But
I won't.
I remember reading someplace actually that overall the market is about 53% equity, meaning that a lot of buildings with long-term holds have built up a lot of equity. It wasn't that everybody refinanced up to the limit as soon as they could, right? So there's a lot of
Yeah.
there's a lot of built up equity in commercial property,
Yeah.
and obviously equity has taken a hit, but that suggests that on the whole,
Yeah. So I read that
yeah,
article, and I think it
yeah,
was Jay.
yeah,
And there's a little bit of twist in this because, again, I'm really worried about the equity, especially, you and I play in a space where a lot of people got excited the last, let's call it 5 years, 4 or 5 years.
yeah,
And kind of a twist on that 53% equity is that's total.
yeah.
But if you were to step back and just look at deals done, either purchases or refis in the last 4 or 5 years,
Oh yeah, well
uh,
that's a whole different
it's
story.
it's
Yeah,
it's yeah, and that's the stuff that's going to be a
yeah.
problem.
Yeah. Well, that's the stuff that's going to be a problem, and it's going to be a problem in a couple of ways, right? And you have to look at this as an opportunity or as a big problem, depending on your perspective.
Yeah. If
But
you're in the deal, it's a problem. If you're a buyer, it's an opportunity.
well, yes and no though, because a lot.
Oh,
So
okay.
I was talking about this with some of my other syndicator friends
Mhm.
last week, and one issue that we've identified is that so many LPs got sucked into the market in the last couple of years, or let's say the last couple of years of the bubble,
Mhm.
right? And a lot of them sort of, quote unquote, diversified by investing in multiple deals,
Yeah.
right?
Yeah.
Those people are going to get, a lot of them are going to get wiped out, and
Never come back.
they will never come back, right? They will live the rest of their lives with the trauma of having invested in these deals, and they will never invest again. And
Absolutely.
so what that means as a syndicator is it's going to be really hard to raise money for a long time. And then that's going to further depress the price of real estate, right? So if you're sitting,
That's all I'm hearing you say is prices are going down, man. That's
yeah.
all I keep hearing you say.
So
And
if
you know
you
what?
have
That's okay by me.
Right. So if you're sitting on cash, it's great, right? Or if you have investors who either haven't been burned or they realize like, hey, market goes up, market goes down, you got to be in it for the long run, right? And just, if you got people with that kind of perspective on your investor list, then you'll be all right. But if you're dealing with a lot of investors who have gotten burned, then and frankly, like this just makes me sad. There are investors out there who got swayed by this bonus depreciation
Oh,
thing, right?
yes,
They're going to
yes.
have, they took all this bonus depreciation in year one, and they're going to lose all their equity, and they're still going to owe the recapture
The
tax,
tax. Yeah.
right? So they're not only are they out their equity, but they're going to be on the hook for a big tax bill, right?
Yeah.
And
Once the building retrades, absolutely. Yeah.
yeah, and so that, and the thing
Yeah. Lose
that
twice. Oh,
yeah,
man.
and
Ouch.
so many syndicators are out there selling the tax because listen, they sell what works, right?
Of
Everybody
course.
loves to save money on taxes, but a lot of people just didn't really understand what the implications were, or they just say, well, it's not going to happen. Real estate's not going to go down. Multifamily can't go down. It hasn't gone down in the 5 years since I've been in the business, so it can't
Yeah.
go down, right? So
My buddy made $1 million in 7 weeks. So can I. Yeah. Whatever.
yeah, exactly. So they just didn't contemplate, they were very aggressive
Yeah.
about sort of like using these tax strategies, which really are the tax strategies for very sophisticated players,
And
right?
very long-term players.
Very long-term, very sophisticated, and very deep-pocketed players, right?
Yes.
So
Yes.
so so for like family offices that own hundreds of buildings, and they're constantly they're trading in and out of these properties, and and tax strategy is a lot of what they're doing,
Mhm.
right? And they're they're selling a property, and then they have all the recapture tax, and then they're buying one to do the cost set. I mean, that's like how these big players
Yeah.
manage their money. But when you're an LP, right, and you got a job, and you're not thinking about managing, like, you don't have somebody whose job it is in your family office to do nothing other than worry about the tax implications of what you're doing. These
Mhm.
tax strategies can really come to bite you in the ass, and
Yes.
it's just irresponsible for people to have gone around touting these things as like the tax strategy for every man. It just doesn't
It
work
doesn't
that
work. I
way.
mean, I've been screaming for a while, and thankfully we've got receipts we can go back to that the financial engineers, which I think a lot of the last 2 or 3 years were, are going to end up crushing people because they weren't operators. They weren't really in the business. They were chasing easy.
Yes.
And
Yeah.
real estate's never easy.
Yeah. It's so funny.
And it makes me sick.
I was thinking about exactly this point today, that people there's so there are a bunch of people on LinkedIn who have recently been posting about um sort of pushing back against the narrative of like interest rates have to go down, right? And saying like oh, well, interest rates don't have to go down, prices can go down too, right? And the people who are saying, oh, interest rates have to go down, are the people who need interest rates to go down. And that led me to the thought that in the last few years, so many people got into the business who were just making bets, right? It's all they were doing. They were not operators.
No,
They didn't really understand the whole idea of value, right? It was all just buy it and then sell it to the next guy. It was all the greater fool. It was the whole it
exactly.
was all the greater fool theory of investing, right? Except they didn't realize it. They thought that they were doing something, you know, they called it conservative, but they didn't know what that meant. and and as a result of that, you have all these people who need interest rates to go down to bail them out, but they need the casino market to come back to bail them
It,
out. And and you
it's not
and you've
coming.
got and
It's
you've
just
got
not coming.
and at the same time, you know, so now there's a whole other group of people on LinkedIn who are posting about like how as an LP you have to understand all these different things, right? You have to understand this and that, and like you have to become like essentially a real estate analyst. Like, and this is
Yeah.
like going completely to my mind, like way out in left field. Like that's not the point of being an LP. The
No,
point of being an
exactly.
LP is that
No.
you're supposed to be able to trust the person you're investing with. It's supposed to be for you, it's supposed to be easy and boring because the
Mhm.
person you're investing with knows what they're doing, right? You're not supposed to, you don't, the whole point is that you're not supposed to be a real estate analyst. It's like
Yeah.
investing
If I
in
wanted
a
to do that, I would do it. Yeah.
right. It's like investing in a mutual fund. you're not supposed to be a stock picking expert. You're supposed to put your money with, that's why they're earning the fee, right? Because
Right.
they're doing the work. And so now I've got people out there who are, it's, I guess it makes them look good or whatever to go out and say, oh, ULPs should be the experts in real estate now. Well, if they are, then what on earth does the syndicator get a fee for, right?
Yeah,
And if they're
exactly.
not the experts, and it should be easy and boring for the LPs, right? Because the syndicator should know what they're doing. And it just so, but this whole casino market of the last, you know, five
Yeah.
years in particular, but really the whole last cycle. I mean, I was already in 2016 feeling like this market
Ooh.
has
Yeah.
has you know, what's the word? It's gotten too pricey. I mean,
Yeah.
literally, like in 2016, I thought I can't compete with these people, and I had no idea that the market was going to continue to climb
Yeah.
for
For
another
eight
four,
years.
yeah,
Or
for
yeah,
four, well,
whatever.
for 4 years and then explode like the next year after that, right? But it went on for too long,
It did.
and people got complacent, right? So
Yeah. I think the amount of wealth destruction, I mean, just going through that rough math we did, it could tune into the tune of 500 to 700 billion in equity.
yeah,
And again, I want people to hear this. That's before the banks are impaired,
yeah,
right? That's before the banks. And it's the cake's in the oven. There's a couple of, a couple of quarter point rate cuts ain't going to affect that.
yeah, yeah.
Right.
That
It's just not.
Yeah, I mean that's the thing too. I mean, there's so much hype about rate cuts. People are posting about, the Fed's going to start cutting. The Fed's going to start cutting. Well, so what? Like
Yeah.
it'll affect. I
On
mean,
the edges.
yeah, exactly. It'll affect things on the margins, but it is not going to save the deals that were bought at the top of the market with floating rate debt, and at a high leverage, right? And probably, frankly, some of those have like pref equity on top of that too, right? So
Oh,
they're those LPs are not ever going to see a dime again,
no,
and
they're done.
they're done. So
And they're going to have the tax hit for your point.
and they're going to have the tax hit, and it's just I feel terrible about this. I mean, there's a lot of people who just believe that this was going to be a safe thing to invest in, and they ran into some very
Yeah.
good marketers,
Easy
and
money and safe. That's just a bad
yeah,
combination. It's bad. So I
yeah,
want I want to try to put this on a scale of 1 to 10. 10 is max pain. I don't think there's I don't think we're anywhere close to that. I am, like I said, you and I have been talking about this for at least a year. It started to hit Real Deal and other publications about 6 months ago. They're actually putting pictures of people who have deals
oh
in
yeah.
trouble. I
I
mean,
know
that's
some of
that.
those guys. I know some of those guys too. It's like,
Yeah,
yeah, I've
it's
interviewed some of those people on my podcast, right?
oh wow.
Well, I tell you what, the whole time I was interviewing those guys on my podcast, I was thinking, what's the matter with me? Like,
Why
why
can't
can't
I
I
do
do this?
this?
Yeah, why can't I do this many deals? How are they finding deals at work if, they're buying 12 deals a year? Like, I can't even find one. What's the matter with me? I must be a moron. I literally, that's what's going through
I'm
my mind
sure
when I'm,
I could have thought I would have yeah. Yeah.
yeah,
So
or what special sauce do I need to hire an analyst to find these deals for me? Like what's,
yeah, so the
so
answer is they're overpaying and using free money. And
yeah.
now they're going to lose it all. That's what's or most of it. Um so 0 to 10, 10 being max pain. A year ago, you and I were kind of calling, hey, this is going to get nutty. This is going to be an 8 or 9 eventually, but people were probably thinking we're Chicken Little because we were early. It's now hitting the press. To me, I think a lot of people want this time to be the 10.
Oh yeah,
I
this
think
is
we're
gonna be
still at a 3.
yeah,
Like it's a 2 or a 3.
that's the number I was gonna pick as a three. I think we're just really early into this.
Oh,
I
it's
don't think
still way and like if
yeah,
because I'm hearing people call me, both LPs and GPs. I know some people losing buildings.
yeah,
And frankly, they should. I told them this was a bad deal whenever they inked them a couple of years ago. I'm like, I'm not going to invest in this deal because it's anyways bad idea.
yeah,
And they're acting like this is max pain, and I'm like, it's this is just the beginning,
yeah,
right? So we've gone from a 0 to a 2 or a 3. So that just means a lot more pain coming. But I want to go to the other side. as two guys who got out early, as two guys who sold buildings early and admittedly lost money because things exploded, I still feel it was the right decision.
Well, it didn't lose money, lost opportunity, right?
Lost opportunity.
Yeah.
I look at that as still lost money. It's just how I wired. Right, losing $1 million because I sold early still hurts.
Yeah, it still hurts,
But
but
it
you're
still
not out of
hurts.
pocket. You're not out of
True.
pocket, right?
True. I'm not
Yeah.
out of pocket. I'm not out of pocket. That's true. But I'm actually looking at the situation going back to our earlier example, right? $2 trillion, 700 billion wiped out, 1.3. So now if it's 1.3 value,
Yeah.
I could buy them probably at 1.2 because the bank will give discounts, right, to get out. I'm going to have to bring in probably 40% for the banks to be comfortable again. So what's that? 1.248. So it's 480 million or $1 billion have to come in. And then all of a sudden you have a really safe asset. You have an asset that is LTV about 42% of the first purchase price. So that is remarkably safe. That's going to be fun.
I mean, that's how it works, right? And
exactly.
and listen, so I've been hearing since at least 2019 about all the dry powder that's going to step in the minute multifamily drops by 10% because multifamily is such a good deal and all that. And boy, they're going to jump on a chance to get a 10% discount, and that's going to keep the multifamily market high forever. And there are some very prominent people who are running around saying this publicly, and I wish I had the recordings, but they're out there, right?
Oh yeah, they are.
And I just don't have them personally, but those recordings are out there. And I've been arguing all along that dry powder is on the sidelines for a reason, because it wants generational once in a generation opportunity.
Exactly.
Right.
That's where we're going. That was where I was trying to go, because I think we are going to see the greatest wealth destruction in my investing career.
And
that's coming. And that means the greatest opportunity. That's
right. And the greatest
the
wealth
yin and yang
creation. Right. And
exactly.
And the thing is, and the way that this always works, it worked. This is what happened in the great financial crisis. It's going to happen again. When the bubble pops, this is a transfer of wealth from small to big, right? This is a transfer of wealth from this, because the small investors are the ones who get pulled in at the top of the market from all the hype, because they see everything, they're cautious in the beginning. When there's a crash, I mean, I've got to bring back my market psychology, PSY.
Yeah, we should do.
Because or psychology, cycle with a cycle, right? Sorry, I got it mixed up. The market psychology. Maybe I'll do that on a podcast, one of our shows in coming weeks. But the cycle, this investor psychology cycle is when there's a big crash, even if they weren't in the market, and I think it's going to be worse this time because so many people were in the market, right?
Usually it's just people. It is always worse the next time because people get sucked in.
Right.
It's like a magnet.
So,
dude, I remember 2019. I'm presenting in front of a real estate meetup. I'm a buy and hold residential guy, right? Hey, I'm a one rental at a time guy. And 50% of the room when I do Q&A are brand new syndicators who own no real estate. I'm like, this is going to blow up.
Yeah. So here's the cycle, right? The cycle is there's a crash, right? All of the small investors who are sitting on the sidelines, right? They look at the crash and they're like, oh my God, real estate is really dangerous. I can't invest in that. Oh, that's terrible.
That's terrible. Yeah.
That's terrible. That's a bad idea, right? And this isn't just real estate. This happens with every market. It happens with stocks. It happens with so people sitting on the sidelines see a crash and like, oh my God, I can't invest. I might lose my money, right? The smart people, the smart money jumps in at that point because they see bargains and they know.
Well, I want to one little caveat. The smart money's on the sidelines at that point. And you and I were public, like we're out. We're not playing.
No, but I'm talking about after the crash, right?
No,
So
I agree.
when it bottoms out, right? So
got it. Yep.
So the smart money is out until they start seeing some shoots of recovery, right? So they know that the bottom is in, right? And they know that it's not a false bottom, it's a real bottom, right? So maybe they bought a little bit at the false bottom because they know you're still getting a big discount over previous pricing, but when they feel secure that the real bottom is in, that's when they start piling in,
Oh,
right?
then they go
That
ham. Yeah.
that's the dry powder coming in right there. And then what happens is over time, you see trading activity, and the market goes higher and higher and higher. And those early entrants start selling and taking profits, right?
Mhm.
And so people on the sidelines see the profit and they're like, oh, I got to get in on this. And then as each cycle, as this goes up and up and up, and more people who got in
Yeah.
early are trading out and taking chips off the table, and people are seeing how much money they made, the psychology of a lot of investors or most investors is, oh my God, I got to get in on this before it's too late. The problem is it already is too late,
Yeah, it
right?
is
And
too late.
they get sucked in at the very top. And the higher the market goes, the more people who are on the sidelines, their FOMO just builds and builds and builds and builds and builds until they jump into, and that's the point where there's a crash. And then what happens is it's all of those little guys who buy at the top who then get wiped out. And when they get wiped out, then the big guys come in at the bottom and they buy, and the whole thing starts all over again. So there's this
Yeah.
like constant cyclical, essentially transfer of wealth from poor to rich that happens in every one of these cycles, right?
Mhm.
And so, and we're going to see that again. We're going to see
Oh yeah.
all the LPs, not that they're necessarily poor, but I mean they're not
Yeah.
the big fish, right? And their equity is getting wiped out, and this dry powder, right? This is very patient capital. That's why it's on the sidelines. That's why it's not
Yeah.
waiting for 10% discounts. It's waiting
No.
for 30, 40, 50%
Well,
discounts,
that's
right?
exactly what I was thinking, right? Because if you want to get me to commit significant capital in this space in my markets, I'm going to want to buy something for roughly 50% off peak pricing
Yeah,
because I'm going to have to get high, I'm going to have to get a 60% LTV, right? So you're going to take significant chunks of capital. But if I can buy something at 50% off peak pricing and then go get a 60% loan, I mean, that's your debt structure is going to be 30% of previous pricing.
right,
I'll
right.
be able to hold that forever.
Yeah, exactly. And you can even I mean, you can safely refinance that,
At some
right?
point, yes.
At some point, right? Like in the middle of the market cycle, because there's still room to run, right? But the problem is like the greed, but it's because you're not greedy, right? You're in this for the long term. The
Yeah,
problem is that the greed, as the market climbs, the greed grows, right? And
it
as the
does.
greed grows, then the margin of safety gets thinner and thinner and thinner, and people start doing riskier and riskier stuff. The irony of all of this is that as the market is climbing and people are getting more and more greedy and the margins are getting thinner and thinner, and the margin of safety is basically zero, that's when people think it's safe, right?
Yeah, because
Because they're
everybody's in.
because everybody else is doing it. They think, oh, everyone else is doing it, so it must be
Uh,
safe. And
yeah.
that's that's the riskiest time to do it. That's why, you know, the Joe Kennedy shoeshine boy example
Yeah.
is that, like, or your example of going to a meetup and everybody's a syndicator, or
Oh,
10 years ago, or I guess longer
yeah.
ago than that, everybody was a house flipper,
Yep.
right? When everybody is doing it, that's the most risky time.
That is the whole
But
that is the reason I still accept invitations to speak is I want to know what the audience is doing.
yeah,
When the audience is chasing one fad, I don't care what it is, I am out. I am just like out. That's why I do it. And that meeting in 19, I still remember. I remember exactly where it was in San Jose, California. There was, in that room, there was probably 80 people. There was those folks are all tech workers, so they all have stock and all this. There was probably 200 million bucks of
mm,
dry powder in that room. They were all trading, you know, they were all dude, they were talking about markets they'd never been to.
yeah,
Never couldn't tell me a stat about. I'm like, "Oh my God, this is gonna just not end well. Real estate is not this easy."
yeah.
And, truth be told, a couple of them probably made some money because this was 19. So if they
Oh
bought
yeah.
early enough and they got out in 22, they're probably okay. And they probably made a print. They probably printed money.
The
But that's
the
not how psychology works. They made money once and they doubled down. They win
That's
again.
exactly, yeah. There was
Boom.
none of the people who bought in 19 and sold in 2022 took the chips off the table.
No, they
Well, I
doubled
just
down.
yeah, they did a 1031, right? Oh God, and this just reminds me of, like, it's so funny, like the whole intervening time, like, from like 2019, when I had basically like the the biggest Facebook group for multifamily
Mhm.
on Facebook, and everybody else hadn't followed my lead, right? So when we were having all these amazing discussions in that group, and I was telling people, and people were like, you got a 1030. First of all, there was you have to have every single penny invested, right? Because
Yeah.
somehow
Yeah.
I don't know, cash is trash, cash is trash.
Yeah.
I
Yeah.
and I would say,
Ray Dalio said cash is trash.
and I would say to them, cash is not trash. Cash is an option on opportunity, right?
Absolutely.
Cash is an option. It is not trash. It is a valuable asset. I don't care if you've got inflation, right? Because and at that point, when inflation was 2%, and people were saying, "Oh, but you've got inflation," I was like, "Okay, let's let's scenario play this out. Let's say you sell now, you put the money in the bank, right? You wait 2 years for a good opportunity and you lose 4% of your money, but you're able to buy the property at a 20% discount. Where are you better
Which
off?
do you want? Yeah.
Were you better off leaving your money in the deal and losing 20%, or were you better off gaining 16% by netting 16% because you lost 4% to inflation and you got 16%? Which is better, right? Oh no, you got to have every penny invested because of inflation. Even with high inflation, look what
These
happened.
people,
We
these people had not seen a cycle.
we actually
That's the
had
problem.
we had this scenario, Michael. We had this exact scenario. People were calling it hyperinflation. It was not hyperinflation.
No, it wasn't
It
hyper.
was
It was
it was
high.
6-7%. That's not hyperinflation, right? So let's say that went on for 2 years, right?
Sure.
You lose 14%, but you've now lost all your equity, right? Which would you rather have? You rather have your equity minus 14% or lose all your equity, right?
Yeah.
100% loss is a lot worse than a 14% loss. Plus, you would have that money now to put into deals when they're trading at a huge discount, right? But everybody's like, no, 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 you got to save on the taxes. You got to do 1031. It's like,
No,
that's,
that's exactly right. Everybody in that meeting who won
yeah,
did it again. They stayed in. It was a classic gambler's dilemma or whatever, right? You're hot. You're
yeah.
hot. So what do? Instead of $100 bets, you're doing 200 or you're going to 1,000 or whatever it is. And the longer you stay at a casino, the bigger the chances you're going to get your head cut off.
Yeah. And the other thing too about 1031, but I've argued about 1031 for a long time. I my view on 1031 is that 1031 is a great tool, right? But you use 1031 to when you have a really long-term hold, you've been holding on to something for
Yeah.
years, it has a lot, maybe you've taken out some
It-
money, you've been
Yep.
holding on to it for a long time, you have a lot of built up equity. You want to release that equity when it's a good time to trade up and buy something better, right? So
Yeah.
really kind of at the bottom of the cycle, right? And people are
Yeah, I
like, oh
agree.
no, you're not going to maximize. So what? That's
Yeah.
not the way you use it. You're basically okay. Maybe you took a little bit of a hit because a hit in the Michael Zuber sense of like, I lost money because I didn't sell for more money.
Yeah.
I sold for less money, but you made money on the deal,
You're
right?
right. You're right.
You made money on the deal. Your equity has grown. Now you can go buy a bigger and better property for that
Yeah.
tax free
Yeah.
because you're moving at like when the buying is good, right?
No, you're right.
Not at the top of the market where you're like doubling down essentially on your bet,
No,
right?
I agree.
And but everybody was like doubling down on the bet. Oh, we got to sell now because it's the top of the market, can get the best pricing. Oh, I'm going to 1031 into something better. And it's like, yeah, but what about the market cycle? Oh, well, there is no market cycle in real
Yeah.
estate.
What?
They
So
abolished it. The
yeah,
Fed won't let it. Oh, that was the other one. The Fed
the
won't let
Fed
it
won't let it.
happen. The Fed won't let it happen. Right?
That's crazy. So
Fed
let's
won't
so
let real
let's
estate
play this
fall.
out. Um, this is what I think. Because again, I've been an accredited investor. I've been one for well over a decade. I've been seeing deals like this for well over a decade. This is how I personally look at my opportunities. I want to see if you agree or disagree. First, I look at the investor, the GP, right? Second, I look at the market or the asset or both, right? The asset class. Do I want to be in those? And then the last thing I look at is the deal. I think too many people do it the other way. They look at the deal, the IRR, the whatever, then the market, then the GP. So I go GP, asset/market, then deal. How's that feel?
Yeah, I might flip the top too. I mean, if like maybe this is an asset I don't want to be in, I don't care about the GP.
Oh, okay.
But you know, but assuming that it's an asset you want to be in, then yeah, who is this person? And then how good is the deal? right?
Yeah.
So and I think, you're right. I think a lot of people didn't, uh, the GP was somebody they knew from, a podcast, right?
Right.
Or
Oh, I
bigger
forget who
pockets.
said this. The bigger the name, the lower the deal.
I did see that the other day.
I
Yeah,
wonder
the
who
bigger
said.
the
I forget.
name, like the
Yeah.
worse the deal or something. I
Yeah.
forget.
The
Yeah, I did
lower the
see that.
return for sure.
Yeah.
Yeah.
Well,
The bigger
listen,
the
I
name,
mean,
the lower the
listen,
return.
buddy, Uncle G, right? That's the
Yeah.
classic example of that, right? He was able to raise money really cheaply
Yeah.
because he was very famous and had a huge following and didn't have to pay people money because,
Yeah.
I mean, this is just more market psychology stuff. Like
Yeah.
it's like, it's fun. I don't know how deep we want to go on psychology, and I'm not a psychologist, but there seems to be like repetition kind of breeds trust. Like you see somebody
Correct.
enough and you just sort of trust them, and then you don't really dig into the details,
Mhm.
right? And I think in the old days when it was like when they used to call syndications country club deals,
Uh-huh.
right? Like you actually knew the guy, right?
Yeah.
Because you golfed with him, right? Like
Yeah.
you knew his family, like you knew, like you had a good sense of who, and you also like were hearing from your friends, like, oh yeah, this guy, I've been investing with this guy for years. He's always makes money.
Yeah.
He's never,
Or you could hear he cheats at golf, so don't mess
right.
with him because how you
Exactly.
do
Yeah.
one thing is how you do everything. Yeah.
Yeah, exactly. Exactly. But the problem is when you go and that relationship is attenuated, right? And it's just, oh well, you see the guy, you know, him because he's the guy who jumps into a stadium in a parachute, right?
Yeah.
And oh, therefore he's really rich, so he must be successful and he must be good at what he does, right?
Mhm.
Not necessarily. I mean,
Well, again, I think if you look at Uncle G, he is amazing at what he does,
yeah,
and then he stacks cash and buys assets. And I don't know, I don't know anything about his deals. I'm not in any of his deals, but you see stuff online. It's like, hey, it's a 4 or 5% return.
yeah,
All right, so are treasuries, but there's no upside. There's upside, but anyways, yeah, he doesn't
yeah.
have to pay
So
a lot. That's the key, right? The bigger the name,
well, that's what I'm
the
saying.
less
Yeah,
he
they
has
don't.
to pay. And oh, by the
Yeah.
way, he's got a big team too. That's not they're not working for free. There's some commission or
Oh
salary and
yeah.
all of that.
Yeah, I mean, I mean, I know some people who grew very, very quickly during the bubble have these huge teams, right? They
Ooh.
have a lot of mouths to feed, and they just have to keep on churning and churning and churning,
Those
because
people are the ones that are in the most trouble, I think.
yeah, I mean,
Yeah,
you
if
never
you oh, it's terrible.
look being in New York. Listen, being the New York real estate world, right? The old school New York real estate world was like full of these guys worth many hundreds of millions of dollars or billions of dollars who had like two people on their staff. It was like them and two
Yeah,
and like and some analysts that they paid like $27,000 a year,
you're
right?
right.
Like
They
these
play with
just
some spreadsheets. Yeah.
these cheapskates, right? Who like just kept it all for themselves, right? But they didn't have a huge
No, I
marketing
agree.
team,
Yeah.
right? And that but a lot of these syndicators, massive marketing teams, and and they just had to feed the beast with more fees and
Yeah.
more fees, so they had to do deals. Like there was this is the whole like, God,
It
today's just
should have
rant.
been a
It's just
rent. It
rant
should
day.
have been
It's
rant day.
rant.
Rant.
It's rant
Go,
day
go,
today. But it's
go,
just like
Jonathan.
it's like now I lost my train of thought. Like the shoot, what was I going to say about
They had to feed the beast. That was the
they had
last
to
thing
feed?
you
Oh yeah,
said.
they had to feed the beast. Yeah. So this is the thing that was just like infuriating, right? So they've they yak on all the time about how conservative they are, right?
Yeah.
But they have
One side
put
of their mouth, the other
but
side.
but they've put themselves in a position where they cannot be conservative. They have to do deals. You
Yeah.
cannot be conservative if you are doing that many deals, right?
No, you can't.
Conser-
If you have to
and
make payroll with deals, you are not being conservative.
Yeah, like you have to. It's just crazy. They were not, their incentive structure was wrong, right? Where they could not do deals, right? And believe me, I understand. Like it's rough right now to be a syndicator, and I'm looking at deals and thinking like I really want to do this deal because want to make some fees, but it's like I can't invest for that on that basis. Like
Oh,
I can't like deviate from my discipline because I got to make some money, right? But I think a lot of people they convinced themselves that they were being
yeah.
conservative, when they really weren't. But their real incentive is like, well, we got to get a deal. We got to get a deal because we got all these mouths to feed, right?
Yeah.
So
So at the end of the day, kind of take away from this, I do think we're going to see the greatest wealth destruction. I think it's going to be on steroids. I think a lot of LPs get hurt. I don't know, given our rough math, that I don't think it's this great cascade across the banking system. There will certainly be some institutions that are over concentrated in trouble. But the LP or the equity is where we're going to lose. There will be great deals on the other side. And then lastly, on the scale of 1 to 10, it's only a 2 or a 3. There's a
yeah,
lot more to come.
it's early innings, let's say, if we're going to use a baseball analogy, right? This is
Yeah,
the
yeah.
third or maybe fourth inning of this. I think there's a long
Oh,
way to
it's not
go.
even. It's the middle
Yeah,
of the third. It's not the
yeah.
fourth. Yeah, yeah. Well, Jonathan, you do a lot of amazing stuff. You have a Facebook group. You have a course you're putting out. Where can people find you?
Yeah, apartmentinvestorsclub.com, and Apartment Investors Club on Facebook. And I've been actually, the best place to follow me these days is probably on LinkedIn.
Okay,
So find me on LinkedIn, Jonathan Twombly, follow me, connect with me, and see what I post there. And actually, it might even be better than Facebook because there's just a lot of good conversations going on there these days. So,
awesome. LinkedIn it is, folks.
yep,
Again, where there is great destruction, there will also be generational wealth. I want people to hear that again. Generational
yeah.
wealth.
And if you have cash, right? If you weren't part of this, or if you got out early, or if you're just coming to the channel now and you're just getting curious about real estate, do not be discouraged by what you're about to see. You should look at this as opportunity, right? This
Absolutely.
is not, you know, I'm sorry for all the people who got hurt at the top of the market. I mean, really, I know
We
these
tried to
people.
warn you
They're my,
repeatedly.
I've got friends. I mean, some of these people are my friends, right? So I talk about this blithely, but I mean, I know there's real pain out there. But
Yeah.
for the people who are not in pain, or maybe they've suffered some pain, but they're not, this hasn't damaged them. You
Right.
really should be thinking about the opportunity that's coming, because it will be a great opportunity. It will be a really, if not once in a lifetime, it's a once in 10 years kind of opportunity,
Oh,
right?
I will
And
go one further. I think, I think most investing careers are somewhere between 20 and 40 years. This will be the opportunity
it
in commercial. This
it could
is
well be.
going to be it.
Yeah.
There's no
Yeah.
question. You know, the last one was 80, 81, 82. So 40 years ago. So here we go again. That's my
Well, I think
opinion.
there was a great opportunity after the financial crisis too,
There was, but
but
that was more residential.
yeah,
It did have some carryover, obviously. This one is not residential, all
yeah.
commercial.
Well,
So
if you've got like serious uh guts, buy office, right? Because that's
yeah, yeah, yeah. If you got some cojones and you
yeah,
get one
because
of those
that's
deals,
there's gonna be some super bargains coming up in the
did you?
office,
Oh,
so
I read this the other day. I wish I remembered. So there was an insurance company who owned an office building, I think in Boston somewhere,
yeah.
and they sold. They didn't own it. They owned like 37% of it, which they think is obviously worth nothing. They sold it for $1.
Oh yeah, I saw that.
They
Yeah,
sold their position for $1 to
yeah,
Arbor or someone. I don't remember who it was, but I was like, oh my God, they sold it for $1. What does that tell you? Oh my
yeah.
God. Oh, it's going to be fun. Well, Jonathan, you're
Interesting
amazing.
times.
We'll talk
Thank
next
you.
week.
All right, take care, Michael. See ya.
Mhm.